Warren Buffett turned $10,000 into 27 million, not by trading faster, but by doing almost nothing for decades. The strategy that built the most wealth in modern history looks nothing like what most people are actually doing with their money. Let's start with the core difference because most people get this completely wrong. Trading is the practice of buying and selling financial assets over short periods of time. We are talking days, hours, sometimes even minutes. The goal is simple: capture price movements and pocket the difference. Traders do not necessarily care if a company is good or bad. They care about what the price is doing right now. Investing, on the other hand, is about buying ownership in something you genuinely believe will grow in value over months, years, or even decades. Long term investors are not watching every tick on a chart. They are thinking about where a business will be 5 or 10 years from now. Two completely different mindsets, two completely different skill sets. Neither one is automatically better, but one of them is probably better for you specifically. Now, here is where it gets interesting. Trading sounds exciting. That is the problem. There is something genuinely addictive about the idea of waking up, making a few quick moves in the market, and closing your laptop by noon with money in your pocket. Social media has made this image incredibly seductive. You've probably seen the screenshots, the beach scenes, the Lamborghinis. But here is the reality that those posts never show you. Active trading is statistically one of the hardest ways to make consistent money. Studies have repeatedly shown that the vast majority of day traders lose money over time. This is not because trading cannot work. It absolutely can for some people, but it requires an enormous amount of skill, discipline, emotional control, and time. If you do not have all four of those things dialed in, trading will eat your account alive. So, who actually succeeds at trading? The people who treat it like a professional craft. They study price action, they manage risk obsessively, they keep detailed journals of every single trade. They're not gambling, they are executing a repeatable system with strict rules. The emotional side is often the hardest part. When a trade is going against you, every instinct in your body says, hold on, it will come back. Disciplined traders cut losses fast and move on. That is incredibly difficult for most human beings to do consistently. Now, let's talk about investing because this is where the emotional story flips entirely. Investing feels boring, slow, unglamorous. You buy shares of a solid company or an index fund, and then you just wait for years. Sometimes the market drops 30% and everything looks terrifying. Long term investors have to sit through that discomfort without selling at the worst possible moment. The entire game of investing is about compounding. When you earn returns on your original investment and then earn returns on those returns, the growth becomes exponential over time. History has shown that patient, consistent investors who stay in the market over long periods of time tend to build substantial wealth. The market has historically recovered from every single downturn it has ever faced and gone on to reach new highs. Here is the key question you need to honestly ask yourself: how much time can you realistically dedicate to this? Trading demands your attention constantly. Markets open, you need to be watching or have systems running. You need to be analyzing, adjusting, responding. If you have a full time job, a family, other commitments, the time requirement alone might make active trading nearly impossible to do well. Investing, particularly the passive variety where you regularly put money into index funds or quality stocks and leave it alone, requires far less active time. You could spend a few hours a month reviewing your portfolio and be perfectly fine. Risk tolerance is the other massive factor here. Trading amplifies both gains and losses. A single bad trade can take out a significant chunk of capital if you're not managing risk properly. Investing in diversified portfolios tends to smooth out that volatility over time. If watching your account drop 10% in a week makes you physically anxious, trading will be psychologically brutal for you. If you can zoom out and see a temporary decline as part of a long-term journey, investing will feel much more manageable. There is also a middle ground that many people do not talk about. Swing trading sits between day trading and long-term investing. Swing traders hold positions for several days to several weeks, trying to capture medium-term price moves. This requires less time than day trading, but more active attention than pure buy and hold investing. For some people, this hybrid approach scratches the itch of being active in the market without demanding constant screen time. Here's the honest truth that most finance channels will not tell you. Most people, statistically speaking, are better served by a consistent long-term investing approach. Not because trading is impossible, but because the edge required to beat the market consistently through short-term trading is genuinely rare. Meanwhile, anyone with patience and consistency can benefit from the long-term wealth-building power of compound growth. But you are not most people. You're watching this video, you're asking the right questions, and you are thinking critically about your own situation. The best financial path is the one you will actually stick with. If trading genuinely excites you and you are prepared to put in the serious work it demands, it could be your path. If you want to build wealth steadily without it consuming your daily attention, investing is almost certainly your answer. Drop a comment below telling me which path resonates with you more: trading, investing, or that swing trading middle ground. And if you found this video helpful, drop a like and subscribe, and I'll see you in the next one.